index funds, ETFs. You've probably heard both terms thrown around a lot when it comes to investing. And if you're confused about what the difference is, you're not alone. Most beginner investors have no idea these are actually two different things. And some professionals use the terms interchangeably, which makes it even more confusing. In this video, I'm going to break down exactly what each one is, how they're different, which one is better for beginners, and which specific ones you should actually buy in 2026. Let's get into it. Let's start with index funds. An index fund is a type of investment fund that tracks a specific market index. The most famous index in the world is the S&P 500, which is a list of the 500 largest publicly traded companies in America. Think Apple, Microsoft, Amazon, Google, Nvidia, Johnson & Johnson, Berkshire Hathaway, all 500 of them in one single investment. When you buy an index fund that tracks the S&P 500, you're essentially buying a tiny piece of all 500 of those companies at once. When those companies grow, your investment grows. When they pay dividends, you receive a portion of that too. Now, here's what makes index funds special compared to actively managed funds. An actively managed fund has a team of professional fund managers who spend their days picking stocks, trying to beat the market. They charge high fees for this service, sometimes 1% or more per year. An index fund doesn't try to beat the market, it just copies it. No stock picking, no guessing, just automatic tracking of whatever index it follows. And here's the wild part. Studies show that over long periods of time, index funds outperform about 90% of actively managed funds. The professionals with all their research and resources, beaten by a simple fund that just copies a list. Lower fees, better returns, less stress. That's the index fund. Now let's talk about ETFs. ETF stands for Exchange Traded Fund, and here's the key thing to understand about an ETF. It trades on the stock market just like a regular stock. You can buy and sell an ETF anytime during market hours, at 9:30 in the morning, at 2:45 in the afternoon, whenever you want. The price changes throughout the day just like Apple or Tesla stock. An ETF is basically a basket of investments, stocks, bonds, commodities, packaged together and sold as a single tradable unit on the stock exchange. Now here's where people get confused. Most ETFs are index funds. They track an index, like the S&P 500, but they're structured to trade like stocks. VOO, for example, the Vanguard S&P 500 ETF, is both an ETF and an index fund at the same time. It tracks the S&P 500 index, and it trades on the stock exchange like a stock. So the two terms overlap heavily, which is exactly why so many people get confused. The simplest way to think about it, all ETFs are funds, but not all ETFs are index funds, and not all index funds are ETFs. Still confused? Don't worry, it gets clearer. Let me put the key differences side by side so this is crystal clear. Difference 1, how they trade. Traditional index funds, like FXAIX at Fidelity, can only be bought or sold once per day after the market closes. The price is set at the end of the trading day. This is called the NAV, or Net Asset Value. ETFs, like VOO, trade throughout the day on the stock exchange. You can buy at 10 a.m. and sell at 3 p.m. if you want. The price fluctuates in real time. For long-term investors, this difference doesn't really matter. You're not day trading. You're buying and holding for decades. Difference 2, minimum investment. Traditional index funds sometimes have minimum investment requirements. Some Vanguard funds require $1,000 or even $3,000 to get started. ETFs have no minimum investment beyond the price of one share. VOO costs around $500 per share right now, but most brokerages, including Fidelity, allow you to buy fractional shares. So you could buy $50 worth of VOO with no problem. Difference 3. Expense ratios. Both are extremely cheap compared to actively managed funds, but ETFs tend to be very slightly cheaper. VOO, the ETF, has an expense ratio of 0.03%. FXAIX, the traditional index fund, has an expense ratio of 0.015%. Both are essentially free. The difference is negligible. Difference 4, tax efficiency. ETFs are generally slightly more tax efficient than traditional index funds due to how they're structured. However, if you're investing inside a Roth IRA, this doesn't matter at all because everything is already tax-free. Difference 5. Automatic investing. Traditional index funds are easier to set up for automatic monthly contributions. You can say invest exactly $200 every month on the first of the month, and it happens automatically regardless of the share price. With ETFs, automatic investing is possible at most brokerages now, but it was historically a bit more complicated. So to summarize the differences, ETFs are more flexible and tradable. Traditional index funds are simpler to automate. Both are excellent long-term investments. So which one should you actually choose as a beginner investor? Honest answer, it almost doesn't matter. Both will give you nearly identical long-term results if you're investing in the same underlying index. But here's my recommendation for most beginners in 2026. If you're investing inside a Roth IRA at Fidelity, go with FXAIX. It's their S&P 500 index fund. Zero expense ratio, no minimum. Easy to set up automatic contributions. Simple. If you're investing at Vanguard or in a regular taxable brokerage account, go with VOO. It's the gold standard ETF. Trusted, liquid, incredibly low cost. If you want total simplicity and don't want to think about it at all. VOO at Fidelity works perfectly fine too. The worst decision you can make is spending so much time comparing these two that you never actually invest anything. They are both excellent choices. Pick one and go. Let me give you a quick rundown of the best index funds and ETFs available in 2026 so you know exactly what your options are. VOO, Vanguard S&P 500 ETF, tracks the S&P 500. Expense ratio 0.03%. The most popular ETF in the world for long-term investors. This is the gold standard. FXAIX, Fidelity 500 Index Fund, also tracks the S&P 500. Expense ratio 0.015%. Essentially identical to VOO, but available as a traditional index fund at Fidelity. VTI, Vanguard Total Stock Market ETF. Instead of just the top 500 companies, VTI tracks the entire U.S. stock market. Over 3,500 companies, even more diversified than VOO. Expense ratio 0.03%. VXUS, Vanguard Total International Stock ETF, covers international stocks outside the U.S. Good for adding global diversification to your portfolio. BND, Vanguard Total Bond Market ETF, for investors closer to retirement who want lower risk. Tracks the U.S. bond market. Lower returns than stocks, but much lower volatility. For most beginners, VOO or FXAIX is all you need. That's it. Keep it simple. Let's wrap this up with a quick recap. An index fund tracks a market index like the S&P 500 and is designed for long-term passive investing. An ETF is a fund that trades like a stock on the exchange throughout the day. Most ETFs are index funds. The two terms heavily overlap. The key differences are how they trade, minimum investments, and slight tax efficiency differences. But for long-term investors inside a Roth IRA, none of this really matters. For most beginners, buy VOO or FXAIX. Set up automatic contributions. Leave it alone for decades. That is the whole strategy. Next up, watch my video on the S&P 500, what it actually is, why it matters, and whether you should invest in it right now. It's on screen right now. Free beginner investing checklist is in the description below. See you in the next one. Subscribe.